Hi everyone, welcome back to the US CPA classes for FAR. This is part 4 of ASC 606. In this particular video, I'll be walking you through in detail about step 3 of 5-step model, that is key consideration of determining the transaction price. So let's dive into to understand more in detail about how to identify and determine the transaction price.
Detail of the key consideration to determine the transaction price. So transaction price means basically the price at which both the parties have agreed, right? But in that transaction price, there might be different, you can say, component of the transaction price. So we need to identify different component within the transaction price. So first one is, we all know the fixed price, right? For example, if you are purchasing any car along with insurance and extended warranty, so there is some fixed price of the car, there is some fixed price of the extended warranty, and there is some fixed price of the insurance also, right? So that is called fixed price, and in that fixed price, whatever the adjustment comes from start to end is being, like, either it's a variable consideration, it can be a financing component, it can be consideration paid and payable to the customer, or any non-cash consideration. And within those components, there are also some part of it which we need to understand. So first we will be understanding what is variable consideration and the constraint to the variable consideration. Like in our example, if you remember from the last class, we discussed about Mercedes-Benz S-Class, right? We are going to purchase for how much amount? $100,000, right? Do you guys remember it? Yes, no?
Yes, sir.
And insurance was $5,000. And extended warranty was $10,000. That was the total price, fixed price, $115,000, right? In that, you have negotiated and reached to a price of, let's assume, $90,000 for the entire deal. That means you got $25,000 discount. What the discount is? So discounts are generally called constraint to variable consideration. So anything which is adding to the fixed price is called variable consideration, and anything which is reducing the price is called discount, whether it's maybe on account of discount, rebate, or maybe like any other customary practice, right? That is called constraint to the variable consideration. So variable consideration are positive side, which is increasing the value. For example, if you have sold the laptop along with AMC, right? So AMC is a value addition to the laptop deal, right? So here the price are increasing on account of AMC, right? Whereas if you are selling the laptop and you are giving certain discount, that is reducing the price of the laptop, that is called constraint to the variable consideration, right? The thing which is increasing the price is a variable consideration, and thing which is reducing the price are called constraint to the variable consideration. Make sense?
Yes, sir.
Yes, sir.
So if you see over here, the what is variable consideration? Any bonus, incentive, price escalation, right? For example, if you remember the construction contract, so originally we entered into a 4-story building, and luckily we got approval for the 5th story, and now we are giving like additional scope and additional work and additional price, right? Or maybe when like the contractor is working and the price of material have significantly increased, and he's asking for escalation on account of increase in the raw material price, so that is like increasing his revenue, right? So that is called variable consideration. On the other side, what is constraint? Any discount, any rebate, any penalty, any refund which you need to give back to the customer, which basically reduce the consideration, is called constraint, right? The amount of variable consideration include constraint should be estimated by using either of the following method. Whether you have a variable consideration or you have a constraint to the variable consideration, you can measure the value, you can calculate the amount, or you can estimate the amount by any of these two methods. So first method is expected value method. So expected value method is basically the probability weight amount, right? So if there are, like more than two probabilities, generally we use expected value method. But when there is, like yes or no, or two probabilities, or more likely are chances, then we chances of one particular outcome, then we use most likely amount method, right? What is expected method and what is most likely amount method? Expected method is simply giving the probability factor to the price and to calculate the value based on the probability factor. And most likely method is the single most likely amount. It is appropriate when the contract has only two possible outcomes. So for example, you are selling a Domino's pizza, right? And you are giving 50% discount on the next purchase, right? That's what we discussed in the material right example also, right? So how do you calculate the amount you need to allocate for the material right? That will be based on the probability of how many consumer might be utilizing that discount voucher. Yes, no? Huh?
Yes, sir. Yes,
Yes,
sir.
sir.
Yes.
Right? So let's assume 10% of the people would be availing that benefit out of 100, right? So whosoever will be availing the benefit will be getting 50% discount, right?
Right.
Yes, sir.
So that
Yes,
is
sir.
very much straightforward. So if the probability is the people would be availing the benefit and the price is being fixed, then you can use most likely method. Or second is, like for example, in terms of any uh, mm, 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 if you are selling car, how many people would buy extended warranty at the 50% discount, right? So for example, if you are selling 1000 cars in a year and you are estimating that approx out of 1000, 600 people will purchase the extended warranty, right? And if they purchase the extended warranty, then how much will be the discount or how much will be the price, right? So in that case of scenario, the answer is more likely, because either people will purchase it or not purchase it. There is nothing in between. Make sense? So in that case of scenario, you will be using most likely amount method. That means, for example, how you will be doing like estimation. For example, you are selling 1000 cars, out of which you are estimating 600 people would be taking the extended warranty, and extended warranty value is $5,000. Then how will you estimate the amount? For example, your let me add point to say extended warranty price is dollar 10,000, discount dollar 5,000, right? Sales 1,000 cars. Warranty estimated purchase is 600 cars, right? Yes, no? If 600 cars will purchase this warranty, they will purchase at dollar 5,000. Yes. So how much money
Yes, sir.
we can expect? 5,000 multiplied by 600. How much is it? How much is it? 300,000? Yes, no.
Yes, sir. Yes, sir.
Yes, sir.
So this method of estimation is called most likely method, right? And another example, look at like example below here. So the outcome of the probability is A, B, and C. Let's assume you have exported the material to another country, and now that another country is going through the financial crisis. Let's assume you sold the material to Sri Lanka, right? As we all know, Sri Lanka these days is going through the financial crisis, country as a whole, right? And same is the case situation of the customer also, right? Now there is a probability that, let's assume you have sold for $200 per unit. Hmm? So let's assume you have sold unit 100 unit at the rate of $200 per unit. That means $20,000 worth material you have sold to Sri Lanka, any customer in Sri Lanka. But now Sri Lanka is going through the financial crisis, same as the situation of your customer. Now you will identify the probability of the recovery. Let's assume there is a 30% probability that customer will pay $150. There is 60% probability that customer will pay $120, and there's 10% probability that customer will pay $100. Then how do you calculate the amount which you can recognize as a revenue in this scenario, right? 10% of 100, that is $10. 60% of 120, that is $72. 30% of 150, that is $45. So if you sum up all, it is $127. So for this $200, instead of this, you will be recognizing $127 each. So your total revenue will be recognized 12700 instead of 20,000. That is called expected value method. In expected value method, you have different probability of collection or recognition, and accordingly you give the weight to the respective probable amount to calculate the expected value, right? And within this, if somebody asks you to use the most likely method is where the probability is more than 50%. That amount of $120 is the estimate. So if you are using expected value method, your revenue will be 12,700. If you are using most likely method, then your revenue will be $120 multiplied by 200 unit is equal to $12,000.
How do we find the probability?
This will be given to you in question. You are not required to do any estimation in this FAR exam. So for that, practically also you have like legal team will be doing estimation. So as in CPA, probably like this is not our responsibility primarily, but in case if it is being our responsibility, we'll be using the expert to support us. Right? Make sense? Or we may be having experience of past experience or experience of other customer, which we'll be using as a base. But for examination purpose, it is being given to you. Don't worry at all. Make sense? What is most likely method and what is expected value method? Expected value method, when you have different probability. Most likely method you use where you have probability of winning or losing. So more than 50% probability in whatever the scenario you have, that is your most likely method. Shall I remove this?
Yes, sir.
One second. Cool. Okay, so this is about variable consideration and constraint to variable consideration, including both the method to calculate variable consideration and constraint to variable consideration, which is expected value method and most likely method. Now jumping on to the second pillar, which is significant financing component, where in the sales transaction there is a significant financing component is being involved, then you need to segregate that financing component and recognize the revenue of the financing component as interest income or finance income rather than your business income, rather than your operation income. For example, let's say like Ayush has sell its let's say Ayush has a dealership of like this Mercedes, right? So this $100,000 car Ayush has sold to Rahul, right? And normal terms of the payment for the business which Ayush do is 45 days payment. Hmm? But as Rahul is good friend of Ayush and Ayush trust on Rahul, so he has given a 6-month credit period, right? So the 6-month credit period is more than the normal routine business which Ayush do. That means Ayush is giving 4.5 month extra credit, right? And for this extra credit, does Ayush charging any additional amount? First, you need to identify. If not, that means it is being inbuilt into the transaction price. So you need to segregate that. Make sense? So financing component is only you will be considered when there is a significant financing option. Right? For example, normally Ayush is giving 45 days credit, and to Rahul he has given, let's say, 60 days credit. So 15 days probably may not be a significant one. Right? Significant will be the accountant judgment or the auditor judgment or as a CPA judgment, right? So that should be significant in context of the transaction, right? When we consider the materiality, that we consider for the financial statement as a whole. But when it comes to significance of any transaction or financing component, then it will be relating to that particular transaction. If, for example, the car is, let's say, value $100,000 and Ayush has, let's assume, a margin of 5%, right? That is $5,000 only. And let's assume the interest rate in the market is 5%. And Ayush has given on a credit for a year. That means Ayush is not making any money. Whatever the money Ayush is making is just a 5% interest on $100,000, right? So it represents with significant component as a financial support which Ayush is providing to Rahul. So in that case of scenario, that interest income or finance income need to be identified and to be recorded as finance income, but not the income from sale of the goods. Make sense?
Yes, sir.
Prashant, Rahul, Gurmeher.
Yes, sir.
Yes, sir.
Yes, sir.
So here, what you need to do, identify the time value of money, right? What is time value of money? Any idea? What is time value of money?
So basically the interest
Mhm.
और इस कॉन्सेप्ट में हम फ्यूचर वैल्यू को भी हम ले सकते हैं क्या?
Mhm.
We can take it.
No, let me know. Like, it's just a one statement. I cannot say yes or no based on the single statement. If you can just help me understand more.
Value of money changes with time.
Yes.
So a dollar worth today is not necessarily of same value 1 year from now.
Mm-hmm.
So maybe its value might be like whatever I'm purchasing with $1, maybe I will require $1.2 to purchase the same thing.
Mm-hmm. Yeah, inflation impact, right?
Yes,
Or normal interest rate impact, right? And economic growth or overall economic change impact, right?
yes.
Rahul Gurmeher.
So basically, I just want to understand, will we consider like a factor? So when you factor in different things in order to adjust our future value. So
Mhm.
as he stated already, so we factor in the present value of the future outcome, right? So will we
Mhm.
consider that concept here as well?
Sorry, I didn't buy your point completely. If you can just help me
So
understand more in
basically,
detail.
if I have to collect a certain amount in future, so we
Hmm.
factor in today's value, right? We
Hmm.
consider it as what is the value of that amount.
Hmm.
Uh, if I receive that amount after 3 years, although
Hmm.
I am selling it right now,
Hmm.
and the recovery would be done after 3 years. So what will be
Hmm.
that value of that amount after 3 years?
Hmm.
So
Yeah.
is that
Yes.
a concept included in this as well?
Yes. Yes. Absolutely right.
Oh,
So, for example, let's assume today if you can buy a home for $100,000, and instead of buying that home, you have given someone $100,000 interest-free loan, and after 3 years, right? So, would this $100,000 loan interest-free which you have given, you'll be getting back, but the value of the home might be, let's assume, $140,000. So this $40,000 is, like time value of the money, basically, right? So time value of money will be considered based on different factors. One is like inflation in the economic, that is, like what you can purchase today. So, like for example, in India, inflation rate is around 8%, right? So what you can buy today for 100 rupees, for after 1 year, you might be needing 108 rupees to buy the same. Same is the case in US, like their inflation rate is 2%. So what you can buy for $100 today, after a year you can buy the same thing, but you need to invest $102. So this $2 is the time value of money. Make sense?
right, sir, yeah.
Hmm? So
Yes,
if you
yes.
see the theory which you have written here, time value of money, if money is received after 1 year, so then difference between the cash sales and the credit sales, that may be on account of interest, income or expense, to be recognized separately. So hence, like that will result into interest income, and that has to be recognized separately. So it should not be recognized as sale of material or sale of goods or sale of service. It has to be recognized as finance income, right? For example, let's assume you are making a big trucks, right? And you are selling that truck to cash in, let's assume, $100,000, right? But if someone take that truck on finance, right, you sell them at $110. So, sorry, $110,000. So, $10,000 which you are extra charging is basically for financing income, not for sale of good, right? For example, if this $100,000 truck you are selling at $100,000, and sometime you give 10% discount, or most of the time you give 10% discount. So actual or average sales price of this truck is, let's assume, $90,000 if people buy on cash. If people take on credit for, let's assume, 12 month, 18 month, or 24 month, let's assume for 24-month credit, then you sell on $100,000. That means the $10,000 is your finance income. Normally cash sale you give at 90,000, whereas credit sale you don't give any discount. That means the $10,000 which you are extra earning, right? That is on account of financing that for that period, right? Hence, that income need to be identified separately and need to be recognized as finance income or interest income. Make sense? Yeah, Prashant, Rahul,
Yes, sir.
Yes.
Gurunal. Okay.
Yes, sir.
So next, yes, Rahul, you're saying something.
No, sir.
Hmm. Okay. So next component is consideration paid and payable to the customer. So this includes the amount that an entity pay to a customer in the form of cash, credit or other item that the customer can then apply against the amount owed to the entity. And the consideration payable to the customer is generally accounted for as a reduction in the transaction price, that may be discount, voucher, gift voucher, reward points. That is called consideration paid and payable to the customer. Like we were discussing in the morning about, this Domino's example, that may result into material right, but material right is impacting the value of the sale in future, right? So that's a significant discount. So now, earlier we were discussing in context of step 2, that is a performance obligation. Hmm? Now the same thing we are discussing in context of transaction price. So how to identify the transaction price for both the item sales. Hmm? For example, if you have we were discussing in the morning about printer and the cartridge example, right? So let's assume you have purchased an HP printer for, let's say, $300, or maybe let's assume $500. A printer you have purchased for HP, and they have given you discount coupon to buy the cartridge next 3 times at 50%. And let's assume the cartridge price, normal price is $30, right? So let me draw the same example. So printer, once again. Printer is, let's assume, $500. Cartridge, let's assume $30 each, right? And you got material right, 50% on cartridge, right? That means you can purchase this at $15, right? So here, if you see consideration paid and payable to the customer, that means it's most likely that consumer will avail this benefit. Yes or no? So for example, if you have purchased an HP printer, right, you would love to use HP cartridge if you're getting 50% discount. Yes or no?
Yes,
Yes.
sir.
Hmm? So let's assume you have sold 100 printers. Hmm? And in the 100 printers, let's assume 90% of the people would be taking the benefit of this offer. That is 500 multiplied by 90. How much is it? 45,000,
45,000.
right? And those people, those 90 people who are availing the benefit of 15, that means 90 multiplied by 15 into 3, 3 times they are getting benefit. 45, this much they are discount getting. How much is it? Can somebody do the math for me? Can someone do the math for me? 90 multiplied by 45.
3950.
Say that again.
3950.
45 multiplied by 90.
एक सेकंड
4050.
अच्छा मैंने गलती
सर ये ओरली करके बता रहा था ऐसे ही कुछ भी
ठीक है जैन साहब.
हो जाती है कोई गलती
हाँ, बड़े बड़े देशों में छोटी छोटी गलती होती है. So now if you see, like, total price of those 90 printer is 45,000 and the discount you need to give is 4050, right? So this price need to be allocated among 45,000 plus. How much is the normal price? 30 each. 30 into 90. How much is it? 30 into 90. So,
2700
into 3.
into 3 is 8100.
8100. 8100. So this discount need to be allocated among these two in this ratio. We will be discussing like in step 4 allocation of discount, but here you just need to understand like this is the money which is a discount you are giving to the customer need to be adjusted against the transaction price, right? How we need to adjust we'll be discussing step 4, but here only you need to identify this amount which need to be adjusted. Make sense? We are at step 3. We are identifying the transaction price. So transaction price is 45,000 is the sales value, 8100 is the sales value of the cartridge, and the discount of 4050. So total money you will be receiving from the customer is how much? Minus 4050 plus 45,000. So total money you will be receiving is 49050, right? So how you need to allocate this to printer and to the cartridge? That will be discussed in step 4, right? So far we understand this is the transaction price. Make sense? Yes, no?
Yes, sir.
Cool.
Yes, sir.
So let me remove this one. So transaction price include fixed price plus variable consideration minus constant to the variable consideration minus significant financing option, right? Then consideration paid and payable to the customer in future, that will also reduce, right? Then next topic is non-cash consideration, right? So so far we understood what is variable consideration. We understood constant to the variable consideration. We understood significant financing option and the impact of significant financing option. Then we understood consideration paid and payable to the customer. Now last thing in the transaction price is non-cash consideration, that is barter transaction, right? So barter transaction always measured at the fair value of the goods you are receiving, right? Not the goods and services you are providing. I think last time someone of you have shared like dentist or uh, plumber example. Have you guys shared in this class? We discuss dentist and plumber example, or maybe in some other class, I'm not sure. So the example which like I'm not sure we discuss in this class or maybe in some other class. So one of the student has shared an example. Let's assume you are a dentist and at your clinic you required some plumbing service, and plumber is your customer to who required some dental cleaning, right? So normally you charge, let's assume $500 for dental cleaning, and the plumbing work which is required at your clinic may cost around, let's say, $400, right? So now as a dental doctor you have done a barter transaction. You ask like plumber to fix this problem at the clinic, and in consideration of that I'll do your teeth cleaning, right? So the teeth cleaning you normally provide to $500, but plumber charge $400 for the plumbing work normally. So what will be the consideration which you will be considering for the revenue recognition in this case as a doctor? Any idea?
$500.
400, I guess. With a
$400
discount
because,
of 100.
yes, with the discount of 100. Yes, the fair value of the consideration received is your income, not the fair value of the consideration paid. So mind it, So when you are getting into barter transaction, what you are receiving is matter to you, right? What worth value you are receiving is matter to you and need to be considered for the revenue as a transaction price. Make sense? Yep, everyone on same page?
Yes, sir.
Yes, sir.
Okay, so if you see in the transaction price, what are the five key component of transaction price? What are the five key component of transaction price?
Variable consideration,
Oh boy,
constraint.
start with fix. If I summarize everything here, your fixed consideration, fixed price, plus and minus variable consideration or constant to variable consideration, then minus financing option, financing cost, or sorry, financing income, right? Then consideration paid and payable to the customer, right? And then non-cash transaction, fair market value of non-cash. So this is your transaction price. Make sense? What are the five components? What are the five components of transaction price?
सर फोर्थ वाला क्या लिखा है आपने
Fair market value of non-cash
उससे पहले
transaction, consideration paid and payable to the customer.
वो तो सर फिक्स्ड प्राइस जो है वो तो मैं इन दोनों में कंफ्यूज हो गया हूँ
बताओ बताओ.
मैं भी कंफ्यूज हूँ फिक्स प्राइस को हमने कैसे फैक्टर इन किया मतलब फिक्स प्राइस
Fixed
इक्वलेंट
price-
टू combination of these or these are standalone line items for the transaction price.
Yeah, that's the reason I put everything together so that now you will feel yes what is missing out of our understanding. Fixed price, for example, like we're discussing like example of car, right? What is the fixed price of the car? What is the starting point? Dollar 100,000, right? And then extended warranty, how much was that? 10,000. And then insurance, $5,000, right? So this is dollar, how much? 115. So this is your fixed price. And then you'll be adjusting variable consideration or constant to variable consideration. So you ask discount, right? And you have negotiated of, let's assume, $20,000 discount. So this will be reducing the price, transaction price, right? So the balance is dollar, how much? 95,
yes sir
right? So the fixed price is this, then variable consideration is 20,000, variable consideration and constant to variable consideration is this. And this 95,000, let's assume they have given you 1 year financing option. So what is financing component? Finance income you need to reduce. Let's assume dollar 5,000. What will be the transaction price? Dollar 90,000. Right?
5000 minus क्यों कर रहे हैं?
Because that will go to the finance income, not your sales income.
नहीं अगर उसने 95,000 he has to pay us. अगर वो फाइनेंस कराता है एनी हाउ वो 95 थोड़ी देगा वो तो ज्यादा ही देगा ना विद इंटरेस्ट.
What I'm saying, in this 95,000 we agree to pay after 1 year.
अच्छा, this includes the interest component.
Yes.
Okay, okay. ठीक
So
है.
if this 95,000 include interest component, then you need to segregate that interest component and consider in the finance income. So your sales from the car, warranty and insurance should be $90,000,
Okay.
right? Make sense, everyone?
हाँ, यहाँ तक हो गया सर क्लियर। इसके बाद अब आपने लिखा है कंसिडरेशन।
Consideration. For example, here you have sold extended warranty insurance, right? And then you said like if you purchase accessories, will give you 50% discount on the purchase of accessory, right? So here he will buy accessories, let's say $2,000. So that you will add,
ओके ओके
right? And then you'll say instead of this payment of 92,000, and you are giving me old car, that is exchange for dollar, let's assume 22,000, right? So then you'll be reducing the FMV of this 22,000 out of this 92,000, and you're receiving net how much? 70. That will be your transaction price of the sale.
सर एक बार ये फाइनेंसिंग वाला समझाना जरा।
एक second, let me draw into an Excel sheet more clearly.
And sir, वो वाला भी कि जो discounted part था वो कहाँ जाएगा?
Let's do an example on Excel sheet so that it will be easy for everyone. Let me rub this. Once again, let me rub all this. Cool. So, okay, so let's draw an example here. So here's let's see. God. Hmm. So this is your, how much is it? 100,000? $100,000. And this is 10,000 and this is 5,000, right? So fixed price. Fixed price is how much? $115,000. Now you have discount. How much is it? Minus 20,000, you agreed? Yes?
यस सर।
This is called constant to variable consideration, right? Then, in addition to this, this is your after discount. After discount price is 95,000. You got exchange car. Let's assume $20,000 for old car.
सर एक बीच में वो भी कंपोनेंट था 2000
We are coming to that, like we are coming to it, right? And now you have how much payable? 75,000, right?
राइट।
agreed to pay after 1 year. So what is finance income? Let's assume 75,000 and let's say interest is 5%. At the rate of 5%. Right, so plus this multiplied by 0.05. So this is your finance income, right? If you go back here, then you have significant consideration paid and payable to the customer. And to get this deal, you get a discount voucher for accessories, right? That's what we discussed, right? So net payable for car, or you can say payable for car will be this minus this, right? And then you purchase accessories at the rate of 30% discount. On cash. Let's assume you purchased an accessory for 1750. So total value of the sale net is this. Make sense?
सर एक है कि हम लोग ही फिनांस कर रहे हैं ना उसके कंपनी मतलब उसके कार को मतलब
yes.
so the price of the car is 75,000, right? Including all those whatever like insurance, extended
Yes.
warranty, and then and we will be financing this 75,000 with 5% interest rate. So why we are deducting 3750 from 75,000?
That will go into finance income. We are not deducting. So that need to be accounted for in the separate account, not in the sales account.
Still not very clear.
No, in this, like
Sir,
in
actually,
accounting.
I guess your interest हमने factor in किया ना 5%. 75,000 is inclusive interest.
Yes.
हमने क्या किया 75% पे हमने 5% लगा दिया जबकि वो होना चाहिए था मे बी 72 into 5% that constitutes जो भी मतलब वैल्यू बनेगी.
So that I agree. Like just for simplification,
Yeah.
I did this math so that not to complicate math, because like understanding the math is not important. Understanding the concept is important. That we are getting 75,000 after 1 year. Right? So if you are getting 75,000 after 1 year, that means a significant financing component is being involved. Let's assume that financing component is 3,750. So that you need to account for separately as a finance income. So in your profit and loss, we'll say sale of car separately, sale of insurance separately, sale of extended warranty separately, sale of accessories separately, and finance income separately. So in your profit and loss account, this all would be separate line items. So in this finance income, this 3750 will go in a finance income. And this total will be 73,000 plus 20,000 exchange of. Make sense, Prashant?
Yes, sir.
So
Yes.
that's how you will be doing the calculation. But this how you need to allocate the transaction price to different performance obligation. Performance obligation is delivery of car, giving insurance, right? Giving extended warranty and providing accessory. These are like 4 separate performance obligation. So on those performance allocation, we need to identify how much is this 93,000 will be need to be allocated. That we'll discuss in step 4. So as of now, we are discussing like what will be the transaction price for sale of all this item and what will be the transaction price for the finance income. That we have separated here in step 3. In step 4, we'll be understanding how to allocate this 93,000 to sale of car, sale of insurance, sale of extended warranty and sale of accessories. Make sense, everyone? Gurmehar,
Yes, sir. Yes, sir.
Avneet, Rahul.
सर ये सेल्स में 93,000 क्यों लिया, वो डाउट है, मतलब वो क्वेश्चन है.
73,000 plus 20,000 for exchange of old car, fair market value of the old car,
Okay.
right? So that also you are getting, no?
Yes, yes.
So fair market value of that also you need to add, right?
Okay, thank you. Yeah.
So this is all about transaction price side. Now, one second. One second, I need to stop it. No, it's not okay. Cool. Okay, let's do some examples now on the transaction price side. First question is, an entity should estimate an amount of variable consideration in a contract by using either of the following method, depending on which method the entity expect to better predict the amount of consideration to which it will be entitled. First one is expected value method or most likely method. Second is expected value method or cost value method. Third is true value method or fair value method. And fourth is expected value method or the least likely method. So which method is acceptable as per standard? Which methods are acceptable as per standard?
The first one, expected value method and most likely amount method.
What is expected value method and what is most likely method?
So most likely we have two probability, so one probability, right? Two options basically.
Two option and you have like maybe multiple option, but one option is very strong, like more than 50% of the probability of getting that, right?
And in expected value method, we have different probabilities at different costs.
Different outcomes.
So we'll
Yes.
calculate the expected value.
Yes, absolutely true. Second question is regarding the existence of significant financing component in a contract. In determining the transaction price, an entity should never adjust the promised amount of consideration of the effect of the time value of money. So we need to choose which one is the right statement in the light of financing component, basically, right? So first statement says, in determining the transaction price, when you calculate the transaction price, an entity should never adjust the promised. So answer is wrong.
Yes, sir.
Right? Should adjust the financing component.
You should adjust.
Second is a contract with the customer would have a significant financing component if the customer paid for the goods and services in advance. If somebody has already paid in advance, does it have any financing component? The
No.
answer is no, because he or she has already paid, so there's no option of financing. Third is, after a contract inception, the entity should update the discount rate for change in interest rate on or other circumstances, such as change in the assessment of the customer credit risk. So what they are saying, like initially there was like, let's assume $10,000 was price, and you have given $1,000 discount, and rest of the $9,000 you have given on financing. But later on, like finance rate has changed. So would that change discount amount? Are you getting third point?
सर होना तो
After the contract inception, that means you already entered into a contract. An entity should update the discount rate for change in interest. For example, there was $10,000 product which you have given to the customer at $1,000 discount, and the customer agreed to pay $9,000 along with, let's assume, 5% interest over the period of 12 months on a EMI basis, right? Now, market interest rate is changed from 5% to 6%, right?
sir, it will
So, will you be reducing or will you be increasing the discount amount?
no sir, we won't.
Ideally, it should not be. I haven't seen any circumstance where discount has been changed due to market conditions.
Yes.
तो होता है वैसे normally या बिल्कुल नहीं
No,
होता?
no, no, no. If that's the case, it will adjust in finance income,
Okay.
not the discount. Last one is, an entity should use discount rate that would be reflected in a separate financing transaction between the entity and its customer at the contract inception. So what does it mean? An entity should use a discount rate that would reflect in a separate financing transaction between the entity and its customer at the contract inception. So when you are giving any financing option, so the discount rate or interest rate need to specifically mention in that arrangement or communicated in that arrangement. So would it be right or wrong?
Sir,
It's correct because as we separated that component to like recognize under the finance income, so it's correct that
Yes. Yeah,
separate.
just to avoid any ambiguity, in future, it's always good market practice as well as industry practice to clearly communicate or lay down the rate of interest in the arrangement, right? So this is all about step 3.